afternoon to all. We will be covering about Hinduja Leyland Finance, the agenda for the day in terms of we'll be looking at the overview of the company, portfolio overview, borrowing profile, the board and management composition, and then we'll touch upon the other businesses, which is largely Hinduja Housing Finance, which is a 100% subsidiary of Hinduja Leyland Finance. We also have two more businesses. One is Grow Digital Platforms, which is a 50-50 JV between Hinduja Leyland Finance and our parent Ashok Leyland, and Gadi Mandi, which is a 100% subsidiary of Hinduja Leyland Finance. And then we'll briefly touch upon the consolidated financials. So in terms of company overview, in a snapshot, if we have to cover, we have been in this business since 2010. So it is a 13 or 14-year-old history that we have. Just short of touching 50,000 crores of AUM on a consolidated basis as of 31st March. As we speak, we already crossed 50,000 crores. We are part of the Hinduja group. I will not touch upon much. I'm sure most of you would be aware in terms of the verticals or the presence of Hinduja group across the globe. In terms of our synergy with our parent, which is Ashok Leyland, I'll be covering the shareholding pattern in the next slide. As we speak, almost 26% of our overall portfolio consists of Ashok Leyland vehicles, which goes on to say that more than 74% of our portfolio is non-Ashok Leyland. Our area of focus in terms of our business segment has been to be present in the entire spectrum of vehicle loan business, which is right from a heavy and commercial vehicle to two-wheeler. We have a presence across the spectrum, whether it's small commercial vehicle loan, light commercial vehicles, two-wheelers, construction equipment, used commercial vehicle, tractors. We have a presence across that. Over and above, we also have diversified into certain other non-vehicle financing and businesses also, largely to kind of have that diversity coming in again, because we all know in India vehicle financing is a cyclical business. So that was a reason for having a risk diversification in place. Financial, while we'll cover it in detail for the year, last year of FY24, we have ended up with a top line of around 4,600 odd crores and a bottom line of 636 crores on a consolidated basis. In terms of our rating, we are rated by CARE and CRISIL both on long term and short term. We were AA minus in the past. Last year, we got an upgrade from AA minus to AA stable from both CRISIL and CARE, and short term is A1 plus. Both the ratings have got reaffirmed in the current year as well. Most of the points which is coming there in terms of our business overview is kind of mentioned, but one significant achievement which I would like to highlight is the fact that today we have a presence in 1,750 locations across the country. Very safely, one can say that any location which today matters for vehicle sales or financing, we have a presence out there. In the left-hand side bottom graph, which shows the shareholding pattern, as we speak, as of March 24, Ashok Leyland is our parent and it holds 60.4%. We have a holding from Hinduja Automotive, which is at 12.95%. Hinduja Automotive happens to be the parent of Ashok Leyland. We have a small 1.34% holding from Hinduja Capital and close to 0.1% with Asia Corporation. So these are all Ashok Leyland stroke Hinduja group entities, and between these four entities, 75% of the company is held. We got 25% holding coming in from qualified institutional buyers, so that constitutes close to around 24.59%, and a small composition of employee stock options held by key employees. On the right-hand side chart, we have kind of captured the financial highlights for the last 3 years in terms of to give a sense of how the trend lines have moved. So in terms of total asset under management, as I had mentioned, we are just kind of close to 50,000 crores, something which used to be at around 30,000 crores as of FY22. So we have seen a good growth coming in over the last 2 years, which is largely reflective of the way asset classes in which we are present has performed on the ground. Similar to the growth in our AUM is in line with that, revenue growth has happened. And with the bottom line contribution coming in the net worth, which excluding the OCI, which is other comprehensive income, which is notional in nature. So if we exclude that, we are currently at around close to 5,600 crores of net worth that we have. our entire profits, moves into net worth. So as we are unlisted as of now, there is no dividend payout. And in terms of our operational performance in our branch network, we have around close to 413 branches across the 1750 locations that we have a presence in. So we work on a hub and spoke model. In terms of our gross NPAs, FY22, we were at a high of around 6.3, which was largely reflective of the pain which had come in on account of the previous 2 years, which is from FY20 to FY20 onwards on account of the pandemic. Of course, after that, we have seen a significant improvement, which is kind of also reflective of what happened in terms of the overall Indian economy. And that is something which gets reflected out here, because most of the asset classes that we are in are closely linked to the economic growth of the country. So from 6.3, we moved down to 4.4, further moved down to 3.9. A similar movement is what you can see as far as our net NPAs are concerned. Of course, our provision coverage has increased over the period, so that is also getting reflected. Today, we are at around 2.4% as far as our net NPAs are concerned. On a ROA basis, return basis also, we have been consistently kind of treading along after a low of around 2% in FY22, which was reflective of the way things were after the pandemic. We have seen an improvement, which is now at 2.5%. Our borrowing cost was at an all-time low of 7.8. Obviously, this is reflective of the fact that there was a lot of measures put in by Ministry of Finance and RBI during the pandemic period, and that was reflected in terms of cost of funds and liquidity being at what it was. However, post that from FY23, we have seen the hardening of interest rates happening, and cumulative effect of both the systemic interest rate hike as well as the fact that last November, RBI had increased the risk weightages for bank lending to NBFCs. And so both of that put together has resulted in our cost of funds going up from 7.8 in FY22 to 8.9 as we speak. Obviously, we have kind of been to that extent a bit less affected, because during this period, we also had a rating upgrade coming in. So that kind of had helped us in containing most of this increase, because on a systemic basis, we had seen almost close to 250 bips of price hike happening, as well as with the risk weightages going up by 25%, that kind of further, had to go up, but we've been able to contain it at a much lower level. In terms of our capital adequacy, we have been able to sweat our capital over the period from 18.7, we're at 17.3, and much ahead of the regulatory requirement of 15%. In terms of our evolution, it's a bit of a concentrated slide, but I'll try and run it pass through fast. It's basically is to cover and show in terms of how the philosophy or towards diversification had kind of we had looked at and how it has played out for us. So we have plotted it from FY10 from the start of our business till now. And start of the business, when we started off, it was largely focused in the commercial vehicle ecosystem, and therefore the products that we focused on was medium and heavy commercial vehicles, which was largely related to the hub transportation. You had small commercial vehicles and LCVs, which were to the spoke transportation, and three-wheelers, which were the last mile connect. So that's how the entire product focus was for the company. And being a new age NBFC at that point of time, we were more focused on to the SRTO, that is the small road transport operators and first-time user, first-time buyer segment. So that was kind of the entry strategy in FY10 until 2 years. We were on having our growth coming out of these asset classes. However, as we moved ahead into FY12 is the time, as we all know, commercial vehicle business in this country is largely cyclical. Every 3 to 4 years, while the reasons might differ every time, but this business does get into a down cycle. And when it does get into a down cycle, the customer profile, which is at the lower end of the pyramid, which is where we had focus, is the most affected. So when FY12, when we started off, we could see clear imminent signs of a degrowth coming in, and that required us to move focus and add more asset categories which are away from commercial vehicle per se. And that's where it prompted us to move into two-wheeler financing, tractor financing, construction equipment, which were related to our core of vehicle financing. And also we entered into wholesale financing, which was nothing but buying out portfolios of smaller NBFCs who were present in the initial stages. We started off with who were present in the vehicle finance space. Then we kind of diversified into microfinance, looking at NBFCs in the affordable housing finance, looking at NBFCs in the small business loans, so on and so forth. And that's the diversity that we brought in. Further, as we moved up in terms of when we moved into 14 to 17, this was a phase when the cycle again turned and it was kind of getting into a growth phase. But we still continued with our focus on building on diversity to bring in a couple of more non-vehicle financing asset categories, and that's where we looked at setting up our mortgage business, and also which happened in 2014. Largely mortgages or loan against property, as it is categorized, is looked at for self-employed customers, and most of our customers in the vehicle side were self-employed, so there was a connect which came in, and we were focused on the self-occupied residential property as a collateral coming in. And in 2015, given our semi-urban distribution that we had put into place across the country, and also the fact that we had almost all bottom of the pyramid self-employed customer, which were the kind of same profile which comes in for affordable housing, and that prompted us to set up our business and look at building up our focus on affordable housing. During this period, as I had said, in the wholesale financing, we used to finance other NBFCs, HFCs in the housing finance, affordable housing finance. So we had a bit of an understanding from a wholesale lending perspective also. That also kind of helped us in setting up this business. In 2015, we applied for a license. We got the license and we started off our business from 2016. And that's how we got into the business of affordable housing through our 100% subsidiary, Hinduja Housing Finance. From the period between 17 and 19 were largely for consolidation, because in the past 4 years, from 12 to 17, we had launched few businesses. So we were looking at consolidating. We had grown across the country. We had close to around 1,300 branch locations at that point of time. So it was to look at which locations are performing as per the productivity norms, and otherwise, looking at rationalizing and kind of, having a consolidation happening. And in this period, we also kind of had most of our commercial vehicle customers completing one cycle, and therefore the used commercial vehicle business also picked up, and we consolidated our financing, our position in the construction equipment financing also. The period between FY20 to till now has been more to move through this asset categories that we have focused upon, and had built up a reasonably good platform, and looking at how we can better on look at enhancing our processing capabilities, more moving towards the digital side with all the processes either on sourcing or collections and risk management getting digitized. And of course, we were operating in a completed automated model with our integrated ERP in place, but looked at further digitizing and further making it market efficient in terms of managing the turnaround times. And this is the time when we got into certain other digital platforms that we established. One was the freight exchange platform, which I'll cover in detail when we look at Grow Digital platforms, and also the pre-owned digital platform for buy and sell of vehicles, which is housed in the subsidiary Gadi Mandi, which also will come. So this was a period when we moved across into process efficiencies, making it much more customer facing, at the same time making it automated through the digitization route. And this is a period which we went through during the COVID periods, time period also, which also necessitated us to kind of stay away from human touch, and therefore it was kind of a period where customers also were ready to embrace more of digitization. Comes handy to the fact that most of our customers are bottom of the pyramid, so there was a tech adoption which also needs to come in when we look at doing these kind of exercises. Yeah, next. Yeah, just go back one, Sunny. One more. Yeah. So the net impact of all this is in the last line, where when we started off, commercial vehicle as a percentage of our overall disbursements were as high as 83%, and that was the only focus area for us. With this kind of a thought out philosophy of risk diversification, we have been able to bring down that to 34%. The reason or rationale to do that is, as I said, this business of commercial vehicle is highly cyclical, and the rationale for doing it is to make this business franchise much more sustainable, with having diversified asset class focus, which kind of helps us in sustaining through the top line and bottom line across cycles. And that is something as a conscious decision that we were able to do it, and happy to note that we were able to succeed in bringing down the overall percentage of CV as a percentage of our disbursements. Yeah.
I think that works beautifully as a risk mitigation strategy, from coming from a concentrated risk of 83% of a portfolio coming down to as low as 34%.
Absolutely. And that was the intent as well. So in terms of the asset classes that I mentioned, we have present. We have just put across various asset classes as we see in terms of our presence in, and on various parameters, how does this kind of pan out? For example, the MNCV segment, the average ticket size is close to around 40 lakhs. We average tenor is around 4.5%. Given the focus on the SRTO and first time user buyer segment, we have a yield of around 11.5%, which average LTV of 82. Moving on to small commercial vehicles, which is kind of the LCV part, where we have an average ticket size of 7.5 lakhs. Tenor is in the same range. We have a much better pricing kicking in out here at 13.25 and 87% loan to value. And those are largely retail customers. We don't have much of fleet out here. Construction equipment, which is kind of related to commercial vehicles in terms of, it goes along with the deployment side. Every equipment is deployed with tippers. The overall average ticket size is 30 lakhs out here. We are focused largely on the retail excavator, loader, JCB, and so on and so forth. We don't have a presence in the larger tonnage and the specialized equipments, etc., where we don't see that as our forte at all. We are more focused on the retail side. Average turnover is around same 4.5%, 11.5% is a yield that we have out there with 80% loan to value. Tractors is a segment, given our reach, we have been able to kind of focus upon over the period. It's around 4.5 lakhs is our ticket size with a tenor of 4 years. Got a better yield at around 16.5% with an average LTV of 72. Again, these are all largely retail customers only. Same goes for three-wheelers, 3 lakh ticket size with a yield of 22% and a tenor of 3.5 years. Two-wheelers close to a lakh. It used to be around 50,000. Over the period, the ticket sizes have gone up. Average tenor 2.5 years with a gross yield of 22%. Mortgages, which is a business where we fund self-employed customers with security coming in the form of property. Average ticket size is around close to 1.8 crores. Tenor is 10 years and the yield is around 12.5%. Average LTV is at a healthy of 48%. And as I said, almost 78% of this book is self-occupied residential property coming in as collateral. And the balance commercial is also self-occupied. So we don't fund vacant stock. We don't fund industrial property. Housing finance average ticket size is around 12 lakhs. That's where we categorize ourselves into the affordable housing finance side. Average tenure of 18 years with a gross yield of 13%. A very, very comfortable loan to value of around 43%. And we present largely in the tier 2, tier 3 cities. Wholesale financing, which is where we kind of finance other NBFCs, average ticket size is around 5 crores, tenor of 3 years. Our gross yield of 12.5, there's no concept of much of LTV. It is more of direct assignment, PTCs and term loans that we do to this NBFCs. We have been in this business for now 11 years and happy to mention that we have not had, barring a one write-off of 4.5 crores, we have never had any NPAs or overdues in this business. So it has been one of a successful diversification that we have done. And we have been consistent in terms of being present in this segment. Yeah.
Sachin, just wanted to, for the audiences, when you say gross yield, you mean this is the rate at which you are lending money? Is that a fair understanding?
Yeah, absolutely. You're right. So overall, our business operations, can be bucketed into two. Asset financing and housing finance. Asset financing is, which is Hinduja Leyland Finance, a parent, and we have kind of put across various asset classes and the overall, share out here. The medium and heavy commercial vehicles, while it shows 28, it is a mixture of both new and used. So new is around 24%. That is what is the Ashok Leyland component that we were mentioning. Two-wheelers is 6%, loan against property is 18%, tractors is around 3%, portfolio buyout is nothing but the wholesale business, which is at 6%, construction equipment is at 8%, three-wheelers 3% small. So it's a largely diversified book with MNHCV, which used to be heavier. It was to be higher earlier, has now come down to 24%. And as a diversity, we have been building up the non-vehicle business, and that's where we see the loan against property business today at 18%. In a console basis, as we speak, housing finance constitutes around 21%. So if you look at it, 21 plus 6 plus 18, then this is the 40% of book, which is non-vehicle, and the balance is vehicle. So just a brief in terms of our console financials, the way things have moved over the period. So if you look at it, we have been onto a constant or a consistent growth trajectory. In terms of our loan book, we have grown at a CAGR of 28% for the last 10 years. obviously you can very clearly see that between FY20 to FY21 or 22 rather, we have been flattish from 28,100 to 29,900 to 30,000 odd. This is a period when we had, all of us know, we had the pandemic and the after effects of that playing out. As a asset financer, this is a period where it required us to err on the side of caution and go slow and steady. This was an unprecedented kind of a situation where we didn't have anything to back up on to say that how things will move forward. So we had to play it by the month or by the quarter. And as we saw improvements coming in from FY22 August onwards, we again got into a big building mode, and therefore we are seeing growth coming back between FY22 to FY23 and then to FY24. We have the growth trajectory again picking up. The similar kind of a trend line is what you will see as far as our revenues are also concerned, with a consistent growth which happened up till FY20 and then a flattish trend coming in between FY20 to 22, and then from there we are growing. Same reasons as I had mentioned in terms of our loan book growth is what gets reflected, or the reasons behind how the revenue growth has panned out. Again, we've grown at a CAGR of 22%. Disbursement growth, which kind of led to the loan book growth, is also at a 27%, similar to the loan book growth. Again, you will see that between FY20 to FY22, we actually had a degrowth from 14,000 odd crores in FY20. We came down to 10,200, 10,640 in that 2 periods where we had the impact of COVID and the after effect playing out. Again, with sentiments improving from August 22 onwards, is where I again saw the disbursement cycles picking up. So the message that I want to leave to the recipients out here is that very conscious about how the risks are playing out in the system, and accordingly we are looking at how the book growth should be. Where we see risks which are unprecedented, which we don't have a visibility in terms of how it will play out, etc., we kind of readjust our business model and focus more on containing the risk on book rather than adding more risk. The moment we see things improving on the ground and confidence picking up, we again look at growing the book. And the last one obviously is profit after tax, the bottom line contribution, which has been growing at 24%. Again, a similar trajectory between FY20 to 22, largely flattish, and then again the growth coming back. So in line, the entire message from what I would like to conclude from this is that as and when we saw risk playing out, we were in a position to hold on to our growth and manage the book and look at containing the risk on book. As we see and the situations improving on ground, confidence picking up, again back into the growth. So we have the ability to slow down, contain, and then go for a growth given the way the market changes. In terms of the key financial metrics, as we kind of measure ourselves, so is the case for the NBFCs. One, critical factor which kind of plays out very, I would say, good for us has been historically we have been one of the lowest in terms of cost to income ratios. We were at a base of around 10, and then we have been kind of maintaining it around that. Of course, after COVID, we had to invest substantially in terms of our from the as we had said between FY20 and onwards, we are kind of looking at moving more towards the digitization side. So we have invested onto our technology capabilities and also onto our human resources capability in terms of having separate structures for each of the product lines, from a risk containment perspective, having collection structures which is across buckets, so on and so forth. Also, with part of it coming in because of the regulatory interventions coming in, the changes which have happened in the environment. So all this has led us to kind of having an increase in our cost to income ratio. However, the underlying fact is that we still are one of the best as far as cost to income ratio. The reason we are highlighting this is that this ratio is something which is very internal to us. On the top line, it's largely competition driven. On the credit cost, you have a lot of this environmental factors, both external and internal, coming and hitting, and therefore that has an impact on the the credit cost. Cost to income is something which is very, very internal to us, and that's where we kind of look at building on our efficiencies. In terms of our ROA on a PBT basis, we have, as I said, we see a dip which has happened between FY21 and 22 for the reasons that I had mentioned earlier, and now we are seeing that bounce back coming in after growth again picked up. Same is the case as far as return on equity is concerned. In terms of our gross to and net NPAs, we had gone through a transition. The NBFC segment had adopted Ind AS in FY18, which saw a spike in the gross and net NPAs at an industry level. It happened, so it happened for us. we were able to bring it down to 4.3 and 2.6 level from 5 and 3 between FY18 to FY20. And then again, we had COVID and the related impact of that on the portfolio, which led to a spike again in FY21 from 4.3, it moved up to 6.4 and 3.7 on the net. Again, it remained at elevated levels in FY22, and then with the things improving on the ground and our own abilities picking up, we are again able to contain it back to the 4% level, and in the last year in FY21 below 4 with a net of 2.4. And here, we have kind of normalized all the impacts which have come in, and now we are in a steady state. Vikas, would you like to cover the borrowing profile?
So on the borrowing profile, we are very well largely diversified across all the lines together in the bank as well as on the capital market and ECB. We have done our first ECB last year. In the bank line side also, we are fairly diversified across all 30 plus private or public sector banks or foreign banks or all other institutions. Largely, if you see, the banking relationship has been in the increase on a year-on-year basis. The diversified borrowing profile, if you see from 2014 or 24, there is a good amount of banking relationship as well as securitization, which we are able to do that. On securitization piece, the overall 19% has come from 24% on the overall borrowing mix which we had. Quantum of new borrowing has been increased in line with the AUM and the disbursement growth which we have seen. In that, there is a fair mix of securitization and the NCDs and the banking lines which is there. On a cost of fresh borrowing, if you see, largely we have been able to command when we were at AA minus, the one notch above from the market perspective. And today also, we are able to maintain our cost of fresh borrowing on a one notch above from the market, borrowing competitive pricing standpoint of view. And overall cost of borrowing is, hovering at 8 to 9% across last 6, 7 years.
Quickly touching upon our housing finance business, the focus here is to look at purchase of new and old houses, construction of owned houses, and home improvement. Large part of our portfolio lies in the first two buckets. Our focus has been to have a distribution which is largely semi-urban and then urban in nature, and completely focused on the self-employed segment, with almost 80% of our borrowers being first-time home buyers, and women borrowers are a compulsory coming in as a co-applicant. Ticket sizes range between 5 and 50 lakhs. However, our sweet spot lies in below 20 lakhs. That's where our major focus has been. In terms of our growth, obviously the CAGR looks pretty high because the base has been low. FY16 is when we started off. So we have had a consistent growth story in this business. Of course, during the period between FY20 and 22, when COVID and the pandemic played out, housing, as we all know, was the most resilient asset class in terms of a bounce back, both on the business side, on the growth side, as well as on the risk side. And that's something which is getting reflected in terms of a consistency coming in out here as compared to vehicle finance, where we had to go for a slow and steady approach. Yeah. So in terms of the characteristics of the portfolio in brief, if we have to kind of look at, we have been kind of treading along at a very strong asset quality. Gross NPAs at around 2.3 and net is about 1.39. Obviously, in this business, as we see it, if we have our processes on establishing the commercial or the marketable title of the property, where we don't kind of have any kind of deviations or deficiencies on the the legal technical process, our ability to recover all the money and the entire principal is very high, because we have a loan to value of less than 50%. So in any kind of a default situation which kind of arises, largely because we are dealing with self-employed customers and they have cash flow mismatches. But the moment we go through and get through with the SARFAESI orders, immediately we find customers coming on to the table for a settlement, and therefore our ability to recover principal is very high. Only where if we end up having any kind of a fraudulent property coming in, or the title not being clear, is where we will have a problem. Given the processes that we have followed, we have not had any such instances, apart from in the first year we had some kind of losses happening, which were learning for us to put into place. And now we don't have any kind of such instances happening. So to that extent, this gross and net is largely in terms of the time taken for SARFAESI orders to come in and having the settlements happening. Our AUM breakdown in terms of between asset categories, we have a home loan component of around 53%, the low income housing, which is something which we had launched 2 years back to focus on the ticket sizes which are between 5 and 10 lakhs. Our average is around 8 lakhs out there. That is around 10%. 33% is loan against property. The loan against property that we do in Hinduja Leyland Finance is largely urban in nature, where we are focused on the state capitals and the big category cities in the state. Whereas the loan against, and therefore the ticket size of 1.8 crores out there on an average. Here we focus more onto the semi-urban loan against property and the ticket size between 15 and 20 lakhs. So that is a change in segments as we look at it out here. That consists of around 33%. And we also kind of the wholesale business, which we buy out portfolios of other small housing finance companies, which is categorized as PBO, is around 5%. In terms of our key metrics, we have been, as we speak, as of FY24, we ended up with a overall asset under management of 10,550 crores. We have a very strong, growth story coming in out here. We have been able to have our NIMs at around, that's I think the cost of funds at around 8.9%, right, Pratik?
Yes.
Yeah. So OPEX is around 2.8, the credit cost is around 0.8. So on an overall basis, we have a PBT of on an overall basis, our return on assets, we have been kind of at around 5.3 and a return on equity of 29.1%, which is also a function of the leverage at around 6.4 times. So we've been able to build a very, very strong franchise, and we today rank among the top 3 or 4 affordable housing finance companies in the country. In terms of our new businesses, quickly to touch upon, we were present through Ashok Leyland and Hinduja Leyland Finance on the acquire side, which is to say that the vehicles being made by AL and we financing it, so the customers will be acquiring it. We didn't have a presence in the earn and operate side and the dispose side, which is where we kind of looked at establishing our capabilities out here from FY20 onwards. On the earn and operate side, we have set up this company where we have our digital platforms to both on the earn side to have the freight exchange where companies or SMEs place their freights and the truckers bid for it, and that's how the exchange is coming into play. And on the operate side, we are looking at creating operational efficiencies for our customers by having a digital aggregation platform for major cost items like fuel, tire, lubes, telematics, so on and so forth. And on the dispose side, we have built up, this, pre-owned digital platform for buy and sell of pre-owned vehicles, which we have coined it as Gadi Mandi, where we have set up the platform for a digital auction, and we are also looking at building in capabilities for financing, yard services, documentation, so on and so forth. As of now, the platform is up and running. We use it internally for our own repurchased vehicles. As we move forward, we'll be kind of in the year to come, we will kind of open it up for market operations as well. Yeah. So in terms of the new businesses growth, this is the solutions that we offer. We have a freight exchange where we have loads being offered and put into by SMEs, and we have close to around 1,200 SMEs who are now into this platform, and we have close to around 2 lakh trucks which are operating on this platform. We also have the recharge and credit and insurance platform where we look at fuel recharge, fuel credit, bill discounting of the freight bills, etc. We also have a service network where we have close to around 26,000 service professionals across the country onto one platform. Ability out here is to provide for a service backup where a vehicle which is off-road for minor repairs within 4 hours, it is brought on road, and a major repair minus of total loss within 48 hours. So there again, we are clocking around close to 120 crores of monthly revenue. On the fuel side, we have a platform called Indhan where we are aggregators for HPCL and IOC. We here again clock close to around 125 crores of business every month. We are the highest or the largest fuel aggregator for HPCL. We also have a telematics platform which is much advanced than what the OEMs offer. So today, all put together in the next slide in terms of how we have progressed as far as growth is concerned over the last 3 years. If you can go to the next slide, please. Yeah, as I said, in terms of our revenue breakup, this is how we are kind of looked at the freight and fleet business to come up. In terms of, the operating performance, total, we have close to around 90,000 kiloliters in the last quarter that we clocked. And as I said, today we are the largest aggregator for HPCL. The telematics units, we are close to around 3,500, units across 2 lakh vehicles, which are there on the platform. And overall, on as far as Grow is concerned, we are the only freight tech in the country today which has turned EBITDA positive and are on the track to look at becoming PAT positive. This entire business is today funded with a very low capital, around 40 crores of capital, which between Ashok Leyland and we have invested. And we are looking at a tremendous, GTV growth, which is going to come in this business, the way we have coined our solution, which are, and given the fact that between Ashok Leyland and Hinduja Leyland Finance, the scale that can come on this platform is unprecedented as compared to what any other freight techs can do in the country. And we are well in course for us to kind of look at expanding this business. Yeah.
So this forms a part as a subsidiary of Hinduja Leyland Finance?
This is a JV between 50-50 JV between Ashok Leyland and Hinduja Leyland Finance.
Oh.
In terms of quickly to touch upon, the other business that we have put across, it's on the dispose side, which is Gadi Mandi is a 100% subsidiary of Hinduja Leyland Finance. We have established our capability to, have the platform where, right now we are selling our own vehicles, which we repossess, which we put onto the platform, and, we have bidders across the country. In this process, we have seen around 17% increase in our, realizations of our repossessed vehicles. We are in the process of, getting this platform to be up and running as compared to any other pre-owned vehicle platform. And after that happening in the course of this year, we'll go open market as well. And as I had mentioned, we are looking also in parallel setting up capabilities on, managing the stock through a yard management platform, through the auction business through this platform. Looking at, the entire used vehicle business in the country happens through financing. So there's a refinancing option which comes up. Along with that, the required refurbishment, inspection, documentation, etc. So that is something is work in progress. We expect by end of this year, this platform will be fully up and running. Vikas, would you like to cover?
Yeah, so on the financial metrics, largely the numbers represent the growth story which Sachin has covered, but I would just like to mention key business volume numbers for the recipient of the, the audiences here. So our on-book business volume is, around 39,542 crore as compared to March 23, 29,000. So there is a 35% growth. On the AUM front, 36,900 crore has got increased to 49,235. So there is a 33% in the AUM growth. On the borrowing side, there is a around 22,603 crore, and outstanding borrowing is around 36,700 crore. On the gross income side, if you see 3,500 in March 23 has gone to 4,660 crore, which represents around 33% increase in gross income. PAT is increased by 30% from 490 crore March 23. It has increased to 636 crore, and the net interest income has been increased from 1,780 odd crore to 2,098. So there is around 18% increase. Largely, the net interest income is, is offset with the higher cost of borrowing, which is mainly because of the rise in the repo rate. Cost of fund is around 8.9%. As against 8.1%. So against the 250 basis point repo rise, we were able to contain it at around 80 basis point rise towards the last year. On the GNPA front, we have been able to reduce by 13% from 4.9. It has come down to 4.27, and 3.3 has come down to 2.69, and 18.56. On the capital adequacy side, it has come down to 17.25% on the March 24. Largely to say, if you see in our business, which we have covered in our earlier slides also, we are expected to maintain our capital adequacy and sweat out our equity within the range of 17 to 18 and a half or 19. But we had a capital infusion in October 22, whereby the capital was in a very, very comfortable situation of 20% plus, 21% plus. On the LCR front, we maintain a very good liquidity. There is a 200% of kind of LCRs which we maintain. So these are all the financials key numbers. Rest on the profitability side is there. On the balance sheet side, there is nothing. I mean, the share capital movement is largely to come from two. One is the addition of the profit, and second is the capital infusion. Last capital infusion I already briefed was in October 22. Borrowing is 36,000 crore across all banks and capital market and ECB. And on the fixed asset side, the increase is largely coming because of one operating lease business which we have started. Is there. Otherwise, it is in secular in nature from the growth standpoint of view.
Investments in debt securities, municipal debt securities, securitized debt instruments are subject to risks including delay and/or default in payment. Read all the offer-related documents carefully.